Hello there and welcome to the Sleepy Wealth Stories. Tonight we are following the long and winding history of banking, one of the oldest and most quietly powerful ideas that human civilization has ever produced. Long before glass towers rose in city centers and trading screens filled rooms with pale blue light, before any of the language we use today had names for what it described, someone sat across from someone else and decided to trust them with something valuable, expecting it back with a little more than they gave. That moment, unremarkable on its surface, unremarkable in the way that the first spoken word must have seemed unremarkable, was the beginning of something that would reshape empires, fund cathedrals, trigger revolutions, and eventually connect every economy on the surface of the planet into a single, breathing, interdependent system. Banking did not begin with suits and interest rates. It began with grain, with clay tablets, with the need to store what you had grown and the hope that someone could be trusted to give it back. This is a story that spans 5,000 years. It moves through Mesopotamian temples and Florentine counting houses, through the lending desks of medieval Jewish merchants, and the smoke-filled rooms where 19th-century financiers decided the fate of railroads. It passes through the chaos of market panics, and the quiet confidence of a central bank's first day of operation. It lives in the small decisions, the moment a goldsmith realized he could lend what was not his, the moment a politician decided a law that had protected ordinary people for decades was no longer necessary. Banking has always been about distance. The distance between what you have now and what you need. The distance between a person with surplus and a person with ambition. The distance between the world as it is and the world as someone imagines it could become, if only enough capital could be gathered to build toward it. Every loan ever made was a bridge across some version of that distance. And every bank that ever failed was a bridge that broke under the weight of promises it could not keep. Tonight we will travel that entire span. We will begin in the earliest human settlements, where the idea of lending was not yet separated from the idea of worship. We will end in the age of digital finance, where money moves as quickly as light and the banks that hold it are reconsidering what a bank even needs to be. In between, we will meet the people who built these institutions, the people who trusted them, and the people who suffered when that trust was misplaced. If you enjoy these gentle journeys, I invite you to like, subscribe, or share a thought below. It helps others find their way here too, one sleepy soul at a time. But for now, let your shoulders soften and your breathing slow. Let the day loosen its grip and allow your thoughts to drift back through time as we explore the long and remarkable history of banking. Let's begin. The first banks were temples where grain and silver were stored and promises were recorded in clay. In the ancient cities of Mesopotamia, in Ur and Babylon and Nippur, cities that rose along the banks of the Tigris and Euphrates rivers around 3,000 years before the Common Era, the first institutions that might be called banks were not built for money at all. They were built for gods. The great temple complexes that dominated these cities served as storehouses for grain, oil, wool, and silver, the surplus of a harvest-dependent civilization that had learned the hard way what happened when a bad season arrived without a reserve. Priests recorded these deposits not in books but in clay, pressing wedge-shaped marks into tablets that dried hard enough to survive for millennia. What the priests discovered, almost without intending to, was that the people who stored their grain in the temple were rarely all hungry at the same time. There was almost always more grain sitting in the storehouse than anyone needed in a given week. And there were always people in the city. Farmers preparing a new planting, merchants planning a journey, craftsmen starting a workshop, who needed a little more than they had. The priests began to lend. The temple became a financial intermediary, matching the surplus of one household against the need of another, and taking a share of the return for the service. The tablets they left behind record something that feels startlingly modern. Deposits, loans, interest rates, receipts. The fundamental vocabulary of banking was already present in these ancient clay records. The interest charged on a grain loan in Mesopotamia was typically 20%. On a silver loan, it ran to 33.33%, a fraction so specific that it suggests the calculation arrived at through long practice rather than arbitrary choice. These were not primitive approximations. They were the product of accumulated financial thinking, refined over generations in institutions old enough to feel eternal to the people who used them. Mesopotamian scribes invented the written record of debt, nearly 5,000 years before anyone called it banking. Writing and banking arrived together in human history, and it is not entirely clear which one came first. Some historians argue that the need to record financial obligations was among the primary reasons that writing was invented at all, that the first marks pressed into clay were not poems or prayers but accounting. A farmer owed a temple 3 measures of barley. A merchant promised to return a silver loan with interest at the next full moon. These facts needed to be recorded in a way that did not depend on any individual's memory, because memory is fallible and loans are contentious. The earliest known financial documents are around 5,000 years old, written in a script called cuneiform by scribes who spent years learning to press the right combinations of wedge shapes into wet clay. A typical tablet might record a loan of silver with the names of both parties, the terms of repayment, the interest rate, and the names of witnesses who had been present when the agreement was made. When the loan was repaid, the tablet might be destroyed or defaced. When it was not, the tablet survived as evidence that could be brought before a judge if the borrower refused to acknowledge the debt. What is remarkable about these early records is not their simplicity but their sophistication. The scribes understood compound interest, the idea that unpaid interest accumulates into principal and begins to generate interest of its own. They understood collateral, the pledge of land, slaves or family members as security against a loan. They understood assignment, the transfer of a debt from one creditor to another. The conceptual architecture of modern banking was already complete before the pyramids of Egypt were built. The hardware has changed beyond recognition. The logic has not changed at all. The Code of Hammurabi set rules for lending that would feel familiar to any modern borrower. Around 1754 BCE, a Babylonian king named Hammurabi had a set of laws inscribed on a stone pillar nearly 8 feet tall. The laws covered everything from murder to marriage to the proper conduct of innkeepers, but a significant portion of them addressed financial transactions, the terms of loans, the limits of interest, the rights of debtors, and the obligations of those who lent. The Code of Hammurabi was, among other things, a consumer protection law, written by a government that had noticed what unchecked lending could do to ordinary people. The code capped interest rates and set rules about when a debtor could be seized for a debt. It specified that if a borrower suffered a bad harvest, a flood, a drought, a plague of insects that destroyed the crop, the debt could be renegotiated without penalty. It protected widows and orphans from certain kinds of creditors. It required that loan agreements be witnessed and recorded. Reading these provisions, it is difficult not to feel a strange continuity. The same problems that troubled Babylon trouble us still. Predatory lending, debt spirals, the vulnerability of ordinary families to financial shocks. These are not modern inventions. They are as old as the practice of lending itself. Hammurabi's code also reveals something about the politics of ancient finance. Powerful creditors wanted to lend at whatever rate the market would bear. Ordinary borrowers wanted protection from terms they could not fully understand or resist. The king, interested in a stable and productive population, tried to hold the balance. That tension between the interests of capital and the interests of labor, between the freedom to lend and the need to protect, would run through the entire history of banking, from Babylon to the present day, unresolved and probably unresolvable. Ancient Greek temples accepted deposits and made loans, turning sacred spaces into financial ones. Greece developed its banking traditions somewhat independently of Mesopotamia, though trade connections between the two civilizations meant that financial ideas moved along commercial routes just as goods did. By the 5th century BCE, Greek temples were performing many of the same functions as their Mesopotamian counterparts, accepting deposits, making loans, exchanging foreign currencies. The Temple of Apollo at Delphi was among the most financially active, lending to city-states and private individuals while the oracle delivered prophecies in the smoke above. Greek money changers known as tripeditai, a word that simply means those at the table, a reference to the counting tables they sat behind in the market, were among the first private bankers in the Western tradition. They sat at the crossroads of commerce in the agora, the open marketplace at the center of Greek civic life, and they performed a service that any merchant traveling between cities desperately needed. Greek city-states each issued their own coins, and coins from one city were not automatically accepted in another. The tripeditai knew the exchange rates, tested the purity of foreign metal, and took a commission for the service. It was a modest business but an essential one. The Athenian banker Passion, who lived in the 4th century BCE, became wealthy enough to be granted Athenian citizenship, an honor rarely extended to anyone not born there, in recognition of his financial services to the city. His business accepted deposits, made loans, and issued letters of credit that a merchant could take to a correspondent in another port and exchange for local currency. This last innovation, the letter of credit, the idea that a piece of paper could stand in for physical metal, would prove to be one of the most powerful ideas in financial history, though it would be centuries before anyone fully understood what they had discovered. Roman argentarii financed wars, trade, and the quiet ambitions of ordinary citizens. Rome built on the Greek financial tradition, and then expanded it to match the scale of an empire. The argentarii, literally the silver men, were professional bankers who operated from fixed locations in the Roman Forum, accepting deposits, making loans, exchanging currency, and facilitating payments between parties who might be hundreds of miles apart. A Roman merchant who needed to pay a supplier in Antioch did not have to carry a trunk of silver across the Mediterranean. He could arrange the payment through his argentarius in Rome, who would communicate with a counterpart in Antioch, and the debt would be settled in ledgers without a coin leaving the city. Roman banking reached a scale and sophistication that would not be seen again in Europe for more than 1,000 years. The Romans developed early forms of letters of credit, notarial contracts, and interest-bearing loans. They created a crude but functional interbank settlement system. They even developed something resembling a check, a written order directing one's banker to pay a named amount to a named person. Roman law concerning banking was extensive and carefully reasoned, and Roman courts enforced financial contracts with a seriousness that gave lenders confidence and borrowers accountability. What made Roman banking fragile was its dependence on political stability. The argentarii lent heavily to the state, to senators, to military campaigns. When Roman political life descended into civil war, and the currency was debased to fund military spending, the banking system suffered alongside everything else. The collapse of the Western Roman Empire in the 5th century CE did not simply destroy governments and armies. It destroyed the financial infrastructure that had connected a continent's worth of commerce. The recovery would take centuries, and it would have to be rebuilt almost from nothing. When Rome fell, banking did not disappear. It retreated inside monastery walls and merchant ledgers. The early medieval period is sometimes described as a financial dark age, and in some respects it was. The elaborate interbank networks of the Roman Empire had collapsed. The predictable legal frameworks that had made lending enforceable had fragmented into dozens of local customs and jurisdictions. Long-distance trade contracted. The sophisticated paper instruments that Roman bankers had used became impractical, in a world where literacy was rare and legal institutions were unreliable. But banking did not disappear. It transformed. Monasteries became the primary financial institutions of early medieval Europe, partly because they were among the few places where literacy and record-keeping survived, and partly because they had stable, long-term assets, land, endowments, the income from estates that had been donated by pious nobles, that made them creditworthy in ways that most secular institutions were not. The Church officially prohibited the charging of interest, a doctrine called the prohibition on usury, but monasteries found ways to lend through arrangements that provided for the lender's return without being technically called interest. Merchants, too, kept finance alive in the dark centuries after Rome. In the trading cities of northern Italy, Venice, Genoa, Pisa, Florence merchant families maintained private accounts and extended credit to one another across generations. They developed partnership structures that allowed capital to be pooled for a single trading voyage, with profits and losses shared according to each partner's contribution. These arrangements were the seeds of ideas that would eventually flower into the most sophisticated financial institutions in the medieval world. The darkness of the early Middle Ages was not the absence of financial life. It was the retreat of financial life to a smaller, quieter scale, where it waited for the conditions to grow again. Islamic scholars developed financial contracts that allowed profit sharing without the sin of interest. The Islamic world, which expanded rapidly across the Middle East, North Africa, and into Spain and Central Asia during the 7th and 8th centuries, inherited the financial traditions of Mesopotamia, Persia, and the Byzantine Empire and reshaped them in accordance with the teachings of the Quran. Islamic law, like canon law in Christian Europe, prohibited riba, usually translated as usury or interest, on the grounds that money should not breed money, that the lender should not profit from the mere passage of time. But Islamic merchants needed credit just as badly as any others, and Islamic scholars were too practical to pretend otherwise. Over several centuries, they developed a set of financial contracts that allowed for profit and return without violating the prohibition on interest. The mudaraba was a partnership contract in which one party provided capital and another provided labor and management, with profits divided by agreement and losses borne by the capital provider. This was not simply a workaround, it was a genuinely different theory of finance, one in which the lender shared the risk of the enterprise rather than being guaranteed a return regardless of outcomes. Islamic banks in the medieval period were among the most sophisticated in the world. They developed early forms of checks called sacks, from which the English word check may derive, that could be drawn on accounts in distant cities. They created a system of credit transfer that allowed a merchant in Baghdad to make a payment in Cairo without physically transporting money. The trade routes of the Islamic world, stretching from the Atlantic coast of Spain to the borders of China, were lubricated by these financial instruments, and their sophistication exceeded anything available in contemporary Europe. The Knights Templar created the first system of international banking almost without intending to. In 1119, a small group of French knights established an order dedicated to protecting Christian pilgrims traveling to Jerusalem. The Knights Templar, as they came to be known, grew rapidly in wealth, in military power, in political influence, and almost accidentally in financial sophistication. The problem they solved was one that any pilgrim understood. Traveling from France to Jerusalem with enough silver to fund months of expenses was not only inconvenient but dangerous. Bandits lined the roads. Coins were heavy. A pilgrim robbed in Italy had nothing left for Syria. The Templars offered an elegant solution. A pilgrim could deposit silver at a Templar house in Paris, receive a letter stating the amount deposited, and then present that letter at a Templar house in Jerusalem, where the equivalent value would be paid out in local currency. The Templar network, which eventually stretched across most of Europe and the Holy Land, was the infrastructure that made this possible. For a fee, the order guaranteed the value of the deposit and the reliability of the payment. It was, in its essentials, a letter of credit system of the kind that Greek bankers had pioneered nearly 1,000 years earlier. But the Templars operated it at a scale and reliability that made it genuinely transformative. Medieval Jewish moneylenders filled a financial role that Christian law had deliberately left empty. The prohibition on usury in Christian Europe created a problem that the prohibition could not solve. Commerce required credit. Merchants needed to borrow to buy inventory. Rulers needed to borrow to fund wars. Nobles needed to borrow to finance their estates through bad harvests. The prohibition on interest did not make this need go away. It simply made it impossible for Christians to lend to each other at interest, a rule that in practice was observed inconsistently, with monasteries and Italian merchants finding ways around it, but which was enforced enough to create a genuine gap in the market. Jewish law also discouraged usury, but interpreted the prohibition differently, as applying primarily to loans between members of the same community. Lending to outsiders at interest was not forbidden, and so Jewish communities across medieval Europe found themselves in the position of filling a need that Christian society had created by eliminating Christian competition. Jewish moneylenders were not a conspiracy or a cultural quirk. They were a rational response to a deliberate regulatory gap. Someone had to lend. The law had arranged things so that only one group could lend legally. The consequences were ugly and complicated. Jewish lenders were often necessary to the nobles and merchants who used them, and equally often resented for providing a service that those same nobles and merchants depended on. When debts became inconvenient, when kings wanted to confiscate assets without repaying what they owed, Jewish communities were expelled. England expelled its Jewish population in 1290. France expelled Jews in 1306. Spain expelled Jews in 1492. The expulsion served multiple purposes: religious, political, financial. But one consistent effect was the cancellation of debts owed to Jewish lenders. The history of medieval banking cannot be told honestly without acknowledging that its structure was designed to extract value from a minority community while maintaining plausible distance from the activity itself. The Bill of Exchange was a piece of paper that changed the world by replacing the need to carry gold. The Bill of Exchange emerged from the trading cities of northern Italy in the 12th and 13th centuries, and it may be the single most important financial innovation of the medieval period. A merchant in Florence who owed money to a supplier in Bruges did not want to carry silver coins across the Alps and through the roads of France, a journey of weeks, with bandits at every mountain pass. The Bill of Exchange allowed him to give a written promise to a banker in Florence, who would then instruct a correspondent banker in Bruges to pay the supplier the equivalent amount in local currency. The two banks would settle their mutual obligations at the great trading fairs held periodically at Champagne, where merchants from across Europe gathered and banks netted their balances against each other. This system worked because it was built on reputation and relationships. A banker who defaulted on his correspondent's instructions would find himself excluded from the network, a financial death in a world where long-distance trade was the source of significant wealth. The social pressure to honor these paper obligations was enormous, and that pressure, rather than any legal mechanism, was what made the system function. It was a financial system built on trust, enforced by the community of merchants who depended on it, and it worked with a reliability that would have astonished anyone looking at a piece of paper and asking why it should be worth anything at all. The Bill of Exchange also had an important side effect. Because it involved converting currency between two cities at an agreed rate, and because that rate included a hidden return for the banker, it was technically not interest. It was, the church agreed, an exchange fee, profit arising from the fluctuation of currency values rather than the mere passage of time. This distinction allowed Italian bankers to make money on credit transactions, while maintaining the appearance of compliance with the usury prohibition. It was a sophisticated legal fiction, and it allowed a sophisticated financial industry to flourish in a world that officially disapproved of it. The Medici family discovered that money lent across borders could buy power that armies could not. What made the Medici genuinely revolutionary was their approach to risk. They did not operate the bank as a single entity, but as a holding company that controlled a series of semi-independent branches, each with its own books and its own partners who shared in the profits and losses. This structure limited the damage that any single branch's failure could do to the whole network. It was an early form of financial risk management, arrived at not through theory but through hard experience with what happened when a single large loan went bad. The Bardi and Peruzzi, earlier Florentine banking families, had been destroyed by exactly that kind of concentration. The Medici had noticed. Double-entry bookkeeping gave merchants a way to see their finances clearly for the first time. The invention of double-entry bookkeeping, or at least its codification and widespread adoption, occurred in the trading cities of medieval Italy, and its effects on the history of finance were profound enough that some historians consider it among the most important intellectual developments of the late medieval period. The system is simple in principle. Every financial transaction is recorded twice, once as a debit in one account, once as a credit in another. At the end of any period, the two sides of the books must balance exactly. If they do not, something has been recorded incorrectly, and the discrepancy must be found and corrected. Before double-entry bookkeeping, most merchants kept records that were essentially lists. Money in, money out, loans made, debts owed. It was difficult to use these records to understand the overall financial health of a business at any given moment, and errors or fraud could go undetected for a long time. Double-entry bookkeeping changed that. It created a self-checking system in which mistakes showed up immediately as imbalances, and in which the books of the business could be read as a snapshot of its complete financial position at any moment. Luca Pacioli, a Franciscan friar and mathematician, published a description of the system in 1494 that became the standard reference for merchants across Europe. Pacioli did not claim to have invented the system. He acknowledged that Venetian merchants had been using it for at least a century before he wrote about it. But his clear and systematic description, published at just the moment when the printing press was making books accessible to a wide audience, spread the practice far beyond Italy. Merchants who could now see clearly what they owned, what they owed, and what their business was worth were better positioned to make sound decisions, and to catch the people who might be stealing from them. The Bardi and Peruzzi banks collapsed when a king decided that royal debts were not debts worth repaying. The great Florentine banking families of the early 14th century, the Bardi and the Peruzzi, had built their fortunes largely on lending to European monarchs. Kings were, in theory, excellent borrowers. They controlled vast territories and taxable populations. They had long time horizons and could promise repayment across decades. Their debts were backed by the authority of a crown. In practice, kings were among the worst borrowers in history, because they had the power to simply refuse repayment and face no consequence more serious than the lender's disappointment and the reluctance of future lenders to extend credit. Edward III of England borrowed enormously from the Bardi and Peruzzi to finance the early stages of the 100 Years' War with France. The amounts involved were staggering by the standards of the time, the equivalent of several years of English royal revenue. Edward defaulted on these loans in the 1340s. Whether he was genuinely unable to pay or simply unwilling is a historical question that has been debated for centuries. The effect on the Florentine banks was catastrophic. The Peruzzi collapsed in 1343. The Bardi followed in 1346. Thousands of depositors and creditors lost money. Families that had been among the most powerful in Florence found themselves ruined. The lesson drawn by later Italian bankers, including the Medici, was not that kings should not be lent to, but that the concentration of lending to any single borrower was a form of risk that no bank could safely absorb. A loan to a king might be profitable. A loan that represented half the bank's assets was existentially dangerous regardless of who was borrowing. This insight that risk must be diversified across many borrowers rather than concentrated in a few is one of the foundational principles of modern banking. It was purchased at the price of 2 Florentine banking dynasties and the savings of everyone who had trusted them.
Venice pioneered the idea that a deposit could remain yours, even while it was being lent to someone else. Venice in the medieval period was the most commercially sophisticated city in Europe, and Venetian bankers were the first to fully articulate and implement the idea that is at the heart of all modern banking. When you deposit money in a bank, that money does not sit in a vault waiting for you to return. The bank lends most of it out, keeping only a fraction in reserve to meet the withdrawal requests that are expected on any given day. Your deposit is simultaneously yours, you can withdraw it on demand, and not yours because the bank has already lent it to someone else. This practice, known as fractional reserve banking, sounds paradoxical. How can the same money belong to 2 people at the same time? The answer is that it works as long as not everyone tries to withdraw their deposits simultaneously. In normal times, depositors withdraw their money gradually and at different times, and the bank's reserves, the fraction of deposits kept on hand, are sufficient to meet these demands without difficulty. The bank earns the interest on its loans. The depositors earn a safe place for their money and sometimes a small return. The borrowers get capital they could not otherwise access. Everyone benefits as long as the system maintains the confidence that holds it together.
The genius of Venetian banking was to make this system reliable enough that depositors trusted it even knowing, in a general way, what was being done with their money. The Bank of Venice, or more precisely, the various private banks that operated in Venice before a public bank was established, developed reputations for soundness that attracted deposits from merchants across the Mediterranean world. When a Venetian bank maintained its payments through a crisis that destroyed confidence elsewhere, it demonstrated that the fractional reserve model could work, not just in theory, but in the turbulent reality of medieval commerce. That demonstration laid the groundwork for everything that followed. The Bank of Amsterdam, founded in 1609, became a model of stability in a world of unreliable coin. By the early 17th century, the Dutch Republic had become the most commercially advanced society in the world, and Amsterdam had become the center of global trade. Ships arrived from the East Indies, from the Baltic, from Spain and Portugal and the Levant, carrying goods that were bought and sold in a market so large and so interconnected that contemporaries described it with a mixture of awe and incomprehension. But trade at this scale required money, and money in 17th century Europe was an unreliable thing. The problem was coinage. Hundreds of different coins circulated in Amsterdam, minted by dozens of different authorities to dozens of different standards of purity and weight. Merchants spent enormous amounts of time and energy assessing the value of the coins they received, clipping and weighing and testing for debasement. Transactions that should have been simple were complicated by uncertainty about the value of the medium of exchange itself. The Bank of Amsterdam, established by the city in 1609, was designed to solve this problem. The bank accepted deposits of all kinds of coins, assessed them at their actual metallic value, and credited depositors with a standardized unit of account called the bank florin. Merchants could then make payments to each other simply by transferring bank florins from one account to another, a bookkeeping entry that took seconds and was more reliable than any coin transaction. The bank florin became, in effect, the reserve currency of European trade, trusted precisely because it was backed by the silver and gold that depositors had actually brought to the bank. For more than a century and a half, the Bank of Amsterdam maintained a reputation for solidity that made it the envy of every commercial nation in Europe. London goldsmiths discovered that most people never came back for their gold at the same time. In 17th century London, wealthy individuals who needed to store their valuables often turned to the city's goldsmiths, who maintained secure vaults for storing the gold and silver they used in their trade. For a fee, a goldsmith would store a customer's gold and issue a receipt, a paper document stating how much gold had been deposited and promising to return it on demand. These receipts began to circulate. If you held a goldsmith's receipt, you could pay a debt by endorsing the receipt and handing it to your creditor, who could either present it to the goldsmith for gold or use it to pay someone else. The receipt was functioning as money, and the goldsmiths noticed. What the goldsmiths noticed next was even more significant. Looking at the flow of deposits and withdrawals over time, they observed a pattern. People deposited gold. People withdrew gold. But the total amount of gold sitting in the vault never fell below a certain level, because the inflow of new deposits roughly matched the outflow of withdrawals on any given day. There was always a comfortable margin of gold sitting idle, earning nothing, doing nothing, simply waiting in case of a run of withdrawals that turned out, in practice, never to arrive all at once. The goldsmiths began to lend this idle gold out. They issued more receipts than they had gold to back, receipts that represented loans rather than deposits, but that were identical in appearance to the genuine deposit receipts. If the loans were repaid, no one needed to know that the receipts had ever exceeded the gold. The goldsmiths were earning interest on money that did not belong to them, using the depositor's trust as the raw material for a profitable lending business. It was, in its essentials, the same fractional reserve banking that Venice had pioneered. But in London, in the middle of a century of political upheaval and expanding trade, It was about to become the basis for an institution that would change the financial world permanently. The Bank of England was born from a government's desperate need to fund a war it could not otherwise afford. In 1694, England was at war with France, and the English government was essentially bankrupt. The war against Louis XIV was expensive in a way that the existing financial system could not accommodate. The crown's credit was poor. Previous monarchs had defaulted on their debts, and lenders were understandably cautious. Parliament was reluctant to raise taxes to unpopular levels. The army and navy needed to be paid, supplied, and maintained, and there was simply not enough money to do it.
A Scottish financier named William Paterson proposed a solution. A group of private subscribers would lend the government £1.2 million at 8% interest. In return, the subscribers would be incorporated as the governor and company of the Bank of England, with the right to issue banknotes up to the value of their loan. The notes would circulate as money, backed by the promise of the government loan's repayment. The bank would profit from the interest. The government would get its money immediately. Parliament approved the scheme in 1694, and the Bank of England opened for business. The early years were precarious. The bank faced a run almost immediately, as confidence in its ability to maintain payments wavered. It survived, partly through political support and partly through the determination of its directors, and over the following decades it grew in size and importance until it occupied a position at the center of British financial life that no one had quite planned for it to assume. The Bank of England became the government's banker, the bank's banker, and eventually the lender of last resort, the institution that would step in to provide liquidity when the rest of the system was seized with panic. None of this was in the original charter. It evolved, messily and sometimes painfully, from the practical demands of a financial system that kept encountering problems that only a central bank could solve. John Law convinced an entire nation to replace its gold with paper, and then watched the system destroy itself.
Owen Law was a Scottish economist and gambler who had fled Britain after killing a man in a duel, and found his way to France in the early 18th century, where a series of expensive wars had left the French state nearly insolvent. He brought with him an idea that was either visionary or reckless, depending on how generously one interprets what followed. His idea was that the economy's money supply should be determined not by the amount of gold and silver available, a fixed and arbitrary constraint, but by the amount of economic activity that needed to be financed. Paper money, issued by a bank under government authority, could expand and contract as the economy required. Law persuaded the French regent Philippe II, Duke of Orleans, to give him the chance to try. In 1716 he established the Banque Générale, which began issuing paper notes that could be used to pay taxes. The notes were successful, more convenient than coin, widely accepted, and backed by a credible institution. Encouraged, Law expanded his ambitions. He took over the company d'Occident, which held trading rights to France's Louisiana colony, and began selling shares in it, backed by extravagant claims about the colony's mineral wealth and commercial potential. The shares rose. People who had invested became rich, at least on paper. Others rushed to invest, driving the shares higher still. The Mississippi Company, as it became known, absorbed the French national debt, and Law's bank became the Banque Royale, effectively the central bank of France, issuing paper money to fund a bubble that was by now far beyond any rational valuation of Louisiana's actual economic potential. When confidence broke in 1720, it broke catastrophically. The shares collapsed. The notes became worthless. Thousands of families were ruined. Law fled France in disguise and died in Venice a decade later, largely forgotten. The Mississippi bubble was a cautionary tale that France remembered for generations, contributing to a deep popular suspicion of paper money and financial innovation that would influence the country's economic development for more than a century. The South Sea Bubble taught England that financial speculation could ruin people at every level of society. In the same year that Law's Mississippi scheme collapsed, England experienced its own version of the same lesson. The South Sea Company had been given a monopoly on trade with Spanish South America, a trade that the war with Spain had made essentially impossible. and had used its apparent prospects to absorb a large portion of the British national debt in exchange for shares. The shares rose dramatically in 1720, fueled by optimistic publicity, the participation of prominent figures including members of the royal family, and the universal human tendency to believe that prices that have been rising will continue to rise. At the peak of the South Sea bubble in the summer of 1720, the company's shares were trading at nearly 10 times their initial price. People sold their farms and their businesses and their jewelry to buy shares. Members of Parliament, clergymen, merchants, and servants alike were caught up in the excitement, each convinced that they had understood something that others had missed, each expecting to sell before the inevitable end. When the end came, it came quickly and comprehensively. By the autumn of 1720, the shares had lost most of their value. Fortunes were wiped out. Families were destroyed. One of England's most eminent scientists, Isaac Newton, lost £20,000 in the crash, a sum that had represented a significant portion of his savings, and is reported to have said that he could calculate the movements of celestial bodies, but not the madness of men. The Rothschild family built the most powerful private bank in history by mastering the speed of information. Mayor Amschel Rothschild was a coin dealer in the Frankfurt ghetto who, in the latter decades of the 18th century, built a relationship with the Landgrave of Hesse-Kassel that gave him access to the kind of financial flows that most Frankfurt merchants could only imagine. He was meticulous, discreet, and enormously energetic, and he had 5 sons whom he deployed across the major financial centers of Europe: London, Paris, Vienna, Naples, and Frankfurt, like a military commander placing troops on strategic heights. Each son ran a bank. Each bank was connected to the others by a private courier network that moved information faster than any government service of the time.
Speed of information was the Rothschild competitive advantage, and they understood it with perfect clarity. In a world where news traveled slowly and financial markets were constantly adjusting to imperfect information, the ability to know something first, to know that a battle had been won before other traders knew, or to know that a government had defaulted before the news reached the market, was worth an enormous amount of money. The Rothschilds were careful not to abuse this advantage in ways that would expose them to political backlash, but they used it consistently, carefully, and profitably across 4 generations and the entire 19th century. By the middle of the 1800s, the Rothschilds had financed wars, railways, and governments across Europe and beyond. They were the dominant force in the sovereign bond market, which meant that when governments needed to borrow money, which they did constantly for wars and infrastructure and the ordinary business of running a state, they came to the Rothschilds. This gave the family a quiet but genuine influence over European politics that no elected institution possessed. They could not start wars, but they could make it easier or harder for governments to finance them. In the 19th century, that was no small thing. Savings banks were created to protect the wages of the poor from poverty, misfortune, and themselves.
For most of banking's history, banks had served merchants, landowners, and governments. Ordinary workers, laborers, domestic servants, artisans, the vast majority of the population, had no access to banking services and no safe place to store the small amounts they managed to save. Their savings, when they had any, went under mattresses or into earthenware pots or into the hands of neighbors who sometimes returned them and sometimes did not. A single illness, a period of unemployment, a harsh winter could destroy the savings of years and plunge a working family into destitution from which it might never fully recover. The savings bank movement emerged in Britain and Germany at the beginning of the 19th century from a recognition that this was both a financial problem and a social one. The Savings and Friendly Society, founded in Edinburgh in 1810, was among the first institutions specifically designed to accept small deposits from people of modest means, paying a modest rate of interest and providing the safety and structure of a bank to people who had previously had access to neither. The idea spread quickly. By the 1830s, hundreds of savings banks had opened across Britain, Germany, France, and the United States. The savings bank movement was driven by a mixture of genuine philanthropy and social conservatism. Many of its founders believed that the poor would be more virtuous, more thrifty, more sober, more industrious, if they had a mechanism for saving and could see their modest funds accumulate over time. The condescension in this view is obvious from a modern perspective, but the practical effect was undeniable. Savings banks gave millions of people access to a safe financial institution for the first time and created a new category of depositor whose needs and behavior would reshape banking in ways that the founders had not entirely anticipated. American banking was born in a fight between Alexander Hamilton's vision and Thomas Jefferson's fears. The United States emerged from the Revolutionary War with no central bank, no national currency, and a chaotic assortment of state-chartered banks, foreign coins, and continental bills that had been printed so freely that the phrase "not worth a continental" had entered the language as a synonym for worthless. Alexander Hamilton, as the first Secretary of the Treasury, had a clear vision for how to fix this. A Bank of the United States, modeled loosely on the Bank of England, that would hold the government's funds, stabilize the currency, and serve as a financial partner to the new republic's growing commercial economy. Thomas Jefferson had an equally clear vision of why this was a terrible idea. A national bank, as Jefferson saw it, was a concentration of financial power that could corrupt the republic, benefit the wealthy at the expense of the many, and override the rights of states in favor of a federal authority that the Constitution had not explicitly authorized. Jefferson was speaking for a rural, agrarian vision of America, a republic of independent farmers who owed nothing to banks and wanted nothing to do with the financial sophistication that had already begun to make London and Amsterdam wealthy and complicated. The fight between Hamilton and Jefferson over the bank was, at a deeper level, a fight about what kind of country America was going to be. Hamilton won the first round. The first Bank of the United States was chartered in 1791 for 20 years. But the Jeffersonian suspicion of central banking remained powerful, and when the charter came up for renewal in 1811, Congress declined to renew it. A second Bank of the United States was established after the War of 1812 and survived until Andrew Jackson, who shared Jefferson's suspicion of financial power and added to it a personal animosity toward the bank's president, refused to renew its charter in 1832. The United States would not have a permanent central bank again until 1913, a period of 80 years during which it experienced financial panics with a regularity that gradually persuaded even skeptics that a lender of last resort might be necessary after all. Wildcat banks issued their own currencies in the American wilderness, and some of those currencies were nearly worthless. Without a national bank to provide a uniform currency, antebellum America became a chaotic monetary landscape that was, depending on your perspective, either a vibrant laboratory of financial freedom or a disaster waiting to happen. State-chartered banks were authorized to issue their own paper banknotes, backed by their gold and silver reserves and redeemable at their offices for coin. The problem was that some of these banks had very little in the way of reserves and very generous ideas about how many notes they could issue.
The term Wildcat Bank came from the joke that some of these institutions were located in places so remote that only wildcats could find them, the implication being that no one would ever actually try to redeem the notes at the issuing bank's offices. A merchant in New York trying to figure out whether a particular bank's notes were worth accepting had to consult a publication called a banknote reporter, which listed the current discount, the percentage below face value at which various banks' notes were being traded in the market. A note from a sound Philadelphia bank might trade at par. A note from a sketchy Illinois bank might trade at 20 cents on the dollar, or not at all. This system was inefficient, confusing, and occasionally catastrophic. But it was also, in a paradoxical way, appropriate to a country that was expanding westward at a pace that formal financial institutions could barely keep up with. Farmers and entrepreneurs in new territories needed credit to buy land, clear it, build on it, and establish businesses. The formal banking system that served established cities had neither the local knowledge nor the risk appetite to serve these needs. Wildcat banks, for all their failures, did extend credit to people and places that would otherwise have had none. The price of this accessibility was instability, and the American financial system paid that price repeatedly in the 19th century. The Panic of 1837 showed what happens when a country has many banks but no banker of last resort.
Andrew Jackson had killed the Second Bank of the United States with the conviction that he was striking a blow for ordinary Americans against the power of financial elites. In a narrow sense, he was right. The bank had been, among other things, a vehicle for enriching its well-connected shareholders. But the bank had also performed a function that Jackson did not fully appreciate. It had served as a restraint on the inflationary lending of state-chartered banks, and its demise removed that restraint at precisely the moment when a land speculation boom was gathering momentum in the American West. In 1836, Jackson issued the Specie Circular, which required payment for government land in gold or silver coin rather than banknotes. This immediately tightened credit conditions. Banks that had been lending freely against land values suddenly found themselves facing demands for coin they did not have. The contraction spread through the economy. Banks called in loans. Businesses failed. Commodity prices collapsed. By 1837, the country was in a deep depression that lasted until the mid-1840s and destroyed thousands of businesses, wiped out countless fortunes, and left a scar on the American economic memory that lasted for a generation. The Panic of 1837 was not the last such crisis, and each one taught the same lesson in a different way. When a financial system lacks an institution capable of providing liquidity in a crisis, capable of lending freely to solvent banks that are facing temporary cash shortages, a localized problem can become a systemic catastrophe. The bank runs of 1837, 1857, 1873, 1893, and 1907 all followed a similar pattern. A shock to confidence, a rush to withdraw deposits, banks calling in loans to meet withdrawals, the contraction spreading through the economy like a slow fire. The lesson was clear. It just took 80 years for the country to act on it. Investment banks emerged to finance the railroads, which needed more capital than any single investor could provide. The great infrastructure projects of the 19th century, the railroads above all, but also canals, telegraph lines, and urban utilities, required amounts of capital that were beyond the reach of any individual investor and beyond the willingness of most commercial banks, which had learned from hard experience to be cautious about long-term lending against illiquid assets. A railroad company building a line from New York to Chicago might need tens of millions of dollars and might not produce significant returns for a decade or more. How do you finance that? The answer was bonds, long-term debt instruments that paid a fixed interest rate and could be sold to investors anywhere in the world. Investment banks emerged as the intermediaries who assembled these bond issues, sold them to investors, and took a commission for the service. The great American investment banks of the 19th century, firms like Drexel, Morgan, Kuhn, Loeb, became extraordinarily powerful precisely because they controlled access to the capital markets that the railroads depended on. A railroad company that needed to raise money had to go through an investment bank. An investment bank with good relationships with European investors, especially British investors, who had vast amounts of capital and a well-developed appetite for American railroad bonds, could raise that money and take a handsome fee for doing so. The relationship between the railroads and the investment banks reshaped American capitalism. The banks did not simply raise money, they monitored the companies they had financed, insisted on seats on their boards, and sometimes reorganized them when they ran into trouble. The process of reorganizing a failing railroad company, which became common enough to acquire its own vocabulary, Morganization, after J.P. Morgan's particular style of firm-handed restructuring, concentrated industrial control in the hands of a small number of financiers who came to exercise an influence over the American economy that made politicians nervous and the public resentful. J.P. Morgan became America's de facto central bank through force of personality and an almost unlimited line of credit. Pierpont Morgan was the dominant figure in American finance from roughly the 1880s until his death in 1913, and in the absence of a central bank, he was often forced to play that role himself. He was not a warm man or a generous one in the ordinary sense, but he had an absolute commitment to financial stability, partly from principle and partly because financial stability was the environment in which his business thrived. and he was willing to use his own reputation and his firm's capital to maintain it when no one else could.
The most dramatic demonstration of this was the Panic of 1907. A speculative scheme to corner the copper market collapsed in October of that year, triggering a run on the trust companies that had financed it. The run spread. Banks across the country began to restrict withdrawals. The New York Stock Exchange came close to closing, and the United States government discovered that it had no mechanism for stopping the cascade, no central bank to provide liquidity, no lender of last resort to step in and reassure the market. The solution in the end was Pierpont Morgan. He summoned the heads of the major New York banks to his library and refused to let them leave until they had agreed to pool their resources to support the failing institutions. The Panic of 1907 was contained, largely through Morgan's personal intervention, but the episode illustrated with painful clarity that a financial system that depended on the willingness and ability of a single private individual could not be considered a financial system at all. Morgan was 70 years old. He would die 6 years later. What would happen the next time? The question was uncomfortable enough that it finally produced an answer. The secret meeting on Jekyll Island drafted the plan that would become the Federal Reserve.
In November 1910, a group of men boarded a private rail car in New Jersey, using only their first names to avoid recognition, and traveled to Jekyll Island, a private resort off the coast of Georgia. Among them were Senator Nelson Aldrich, who chaired the National Monetary Commission, Frank Vanderlip, president of National City Bank, Henry Davison, a senior partner at J.P. Morgan's firm, and Paul Warburg, a German-born banker who had spent years studying the European central banking tradition and believed that the United States urgently needed something similar. They spent 9 days in secret drafting a proposal for a new national banking system. The secrecy was deliberate. Public opinion was suspicious of Wall Street, and any plan that appeared to have been written by Wall Street bankers for Wall Street bankers would face immediate and probably fatal political opposition. If the proposal were to succeed, it had to appear to be a reform of banking in the public interest, not a consolidation of financial power in the hands of those who already had the most. The Jekyll Island plan went through several revisions over the following years, shaped by the competing demands of bankers who wanted a private institution and populists who wanted strict government control. What emerged in 1913 was a compromise: the Federal Reserve. The Federal Reserve Act of 1913 created an institution designed to prevent panic from becoming catastrophe. The Federal Reserve System that Woodrow Wilson signed into law in December 1913 was an unusual creature by any standard: 12 regional Federal Reserve banks, privately owned by their member banks but serving a public function, supervised by a board appointed in Washington. It was neither a purely private institution, like the Bank of England in its early years, nor a purely public one like the central banks of France and Germany. It was an American compromise designed to be acceptable to as many competing interests as possible, which meant that it satisfied no one completely. The Federal Reserve had three main purposes. It would serve as a lender of last resort to member banks facing runs, lending freely against good collateral to banks that were solvent but illiquid, thereby preventing the kind of cascade that had repeatedly destroyed otherwise healthy financial institutions in the panics of the previous century. It would provide a more elastic currency, one that could expand when the economy needed more money and contract when it needed less. And it would improve the efficiency of the payment system by providing a national clearinghouse for checks and other financial instruments. What the Federal Reserve could not do, and this would become clear with devastating force 16 years after its creation, was prevent a depression caused not by a temporary panic but by a fundamental collapse in economic activity. The tools it had been given were designed for a different kind of problem, and when the Great Crisis came, those tools proved inadequate to the scale of the catastrophe. The First World War forced banks to finance destruction on a scale that peacetime lending had never imagined. When war broke out in Europe in August 1914, the financial consequences were immediate and severe. Stock markets closed across Europe. The London Stock Exchange, which had not closed for more than a day in its history, shut for months. The gold standard, which had linked the major currencies and constrained the expansion of credit, effectively suspended as governments began printing money to pay for armies they could not otherwise afford. J.P. Morgan's firm, in a role that would have been unimaginable a decade earlier, became the fiscal agent of the British and French governments in the United States, raising billions of dollars in bonds from American investors to finance the Allied war effort before the United States itself entered the war. The scale of wartime finance was unprecedented in human history. The belligerent governments borrowed more in 4 years than they had borrowed in the preceding century. They borrowed from their citizens through war bonds. They borrowed from their central banks through the creation of new money. They borrowed from each other and from neutral countries. The debts accumulated were so vast that they would constrain economic and political life for decades after the guns fell silent. The reparations demanded of Germany at Versailles, the inter-allied war debts that poisoned relations between Britain and France and the United States, the inflation that destroyed the German mark in 1923, all of these were consequences of the financial decisions made under the pressure of wartime necessity. The Roaring Twenties turned bank credit into rocket fuel for a stock market rising too fast to be real.
The 1920s in the United States were a decade of genuine economic growth, but also of financial speculation that outpaced any realistic assessment of underlying value. The stock market rose through the decade on the strength of real improvements in productivity, electrification, the automobile, the expansion of consumer goods, but also on the strength of borrowed money. Buying stocks on margin, meaning with a loan from a broker collateralized by the stocks themselves, was widely practiced and loosely regulated. An investor could control $100 of stock with $10 of their own money, which meant that a 10% rise in the stock doubled their investment, and a 10% fall wiped it out entirely. Banks participated enthusiastically in this expansion. Commercial banks that were supposed to accept deposits and make loans to businesses found their way into securities underwriting, investing their own capital in the stock market, and lending to speculators. The line between staid commercial banking and speculative investment banking blurred through the decade, and the Federal Reserve, which had been watching the expansion with increasing concern, found itself reluctant to tighten credit in a way that might cause the very crash it feared. So it waited and the bubble grew. The crash of October 1929 arrived without warning and ended the decade's borrowed confidence overnight. On Thursday, October 24, 1929, Black Thursday, as it came to be called, the New York Stock Exchange experienced the largest selling panic in its history. The market stabilized briefly after a consortium of major banks stepped in to support prices, in a deliberate echo of J.P. Morgan's 1907 intervention. But confidence, once lost, cannot be easily restored by a show of resolve. The following Monday and Tuesday brought further devastating declines, and by the time the selling exhausted itself, billions of dollars of stock market value had been destroyed.
The crash itself was not the Great Depression. Stock market crashes had happened before, in 1873 and 1893 and 1907, without producing decade-long economic catastrophes. What turned the 1929 crash into the Depression was a combination of factors: the deflation that followed the contraction of credit, the agricultural distress that predated the crash and worsened it, the trade wars touched off by the Smoot-Hawley tariff, and above all, the collapse of the banking system that translated a financial crisis into an economic one. The crash was the match. The banking system was the fuel. The Great Depression closed more than 9,000 American banks and made ordinary savings feel like a gamble. Between 1930 and 1933, more than 9,000 American banks failed. 9,000! The number is so large that it is difficult to absorb. Each failure meant depositors who could not access their money, who walked to a bank whose doors were locked and whose windows were dark, and understood that the money they had saved was gone. Not reduced. Not temporarily unavailable. Gone. There was no deposit insurance. There was no government guarantee. If your bank failed, you lost whatever you had kept in it. The failures fed on each other. When one bank closed, depositors at other banks, fearing the same fate, rushed to withdraw their money. The withdrawals forced other banks to call in loans to meet the demand, which reduced the credit available to businesses, which reduced business activity, which reduced employment, which reduced deposits, which increased the pressure on banks. It was a self-reinforcing spiral, and the Federal Reserve, hampered by its own confusion about its role, by gold standard constraints, and by a failure of imagination about what was required, did not intervene effectively. It allowed the money supply to contract by nearly a third between 1929 and 1933. The consequences were catastrophic. Franklin Roosevelt declared a bank holiday, and for 4 days the most powerful economy on Earth ran without banks. By the time Franklin Roosevelt was inaugurated in March 1933, the banking system had reached a state of effective collapse. Banks in nearly every state had been ordered closed or restricted by their governors. The Federal Reserve Bank of New York, the most important in the system, was on the verge of suspension. The entire institutional structure of American finance, built across a century and a half of practice and crisis, was within days of a complete breakdown. Roosevelt's response was decisive and unconventional. 3 days after his inauguration, he declared a national bank holiday, closing all banks in the United States for 4 days. It was a move that had no legal precedent and that risked confirming the very panic it was meant to stop. But Roosevelt understood something about psychology that his predecessors had missed. The worst thing that could happen, a complete banking collapse, had effectively already happened. The bank holiday did not make things worse. It stopped the bleeding and bought time for a response. Over the 4 days of the holiday, Treasury officials worked around the clock to develop a plan for reopening banks on a graduated basis. Only the soundest first, then progressively weaker institutions as confidence was restored. Roosevelt addressed the nation by radio, explaining the plan in terms simple enough for anyone to understand, reassuring depositors that the banks that reopened would be safe. When the first banks reopened on March 13th, deposits exceeded withdrawals across the country. The panic was over. What Roosevelt had done, essentially, was to use the authority of the presidency and the power of clear communication to restore the confidence that the banking system had lost, and to do so quickly enough that the restoration of confidence preceded the restoration of sound banking, rather than the other way around. The Glass-Steagall Act drew a wall between the bank that held your savings and the bank that gambled with them. Congress's response to the banking crisis included a set of reforms that would shape American finance for the next 60 years. The Glass-Steagall Act of 1933, named for its sponsors in the Senate and the House, addressed what many reformers identified as a central cause of the 1929 disaster: the entanglement of commercial banking, the business of accepting deposits and making loans, with investment banking, the business of underwriting and trading securities.
The logic of the separation was straightforward. When a commercial bank got into investment banking, it faced a fundamental conflict of interest. If the securities it was underwriting declined in value, the bank had an incentive to push those securities onto its depositors, people who trusted the bank with their savings, rather than disclose the losses. The separation of the two activities, enforced by law, would protect depositors from this conflict. Commercial banks would accept deposits and make loans. Investment banks would underwrite and trade securities. Neither could do both. The act also created the Federal Deposit Insurance Corporation, which guaranteed bank deposits up to a specified limit. This was, in retrospect, the single most important banking reform of the 20th century. With deposit insurance, ordinary people had no reason to panic when a bank ran into trouble. Their deposits were safe regardless of what happened to the bank. The self-reinforcing bank runs that had destroyed thousands of institutions in the early 1930s could not happen in a world where deposits were insured. They haven't in the United States since. Deposit insurance was the single most important banking reform of the 20th century. The Federal Deposit Insurance Corporation opened for business on January 1, 1934, guaranteeing deposits up to $2,500, a limit that has been periodically raised over the decades, reaching $250,000 after the financial crisis of 2008. The response of the public was immediate and positive. Bank runs, which had been a recurring feature of American financial life for more than a century, essentially stopped. Depositors who knew their money was safe had no reason to join a run, and without the possibility of a run, the self-fulfilling prophecy of banking panics was broken.
The mechanism by which deposit insurance worked was almost paradoxical. By guaranteeing that a bank failure would not harm depositors, it removed the incentive for depositors to monitor their bank's soundness. If your money is safe no matter what the bank does, you don't particularly care what the bank does. This created what economists call moral hazard, the risk that the insurance would encourage banks to take risks they would not otherwise have taken, because the downside of those risks would be borne by the insurance fund rather than the bank's owners. Managing this moral hazard, keeping the insurance that made banking stable from also making it reckless, would be a central challenge of American banking policy for the rest of the century. The Bretton Woods Agreement made the American dollar the anchor of the global financial order. In July 1944, as the Second World War was approaching its final year, representatives of 44 Allied nations gathered at a resort hotel in Bretton Woods, New Hampshire, to design the post-war international financial system. The memory of the 1930s was vivid. The competitive devaluations, the trade wars, the collapse of international lending. These had not only worsened the Depression but had contributed to the political instability that had produced the war itself. The architects of Bretton Woods were determined to build something more stable. The system they designed placed the American dollar at the center of the global monetary order. The dollar would be convertible to gold at a fixed rate of $35 per ounce. All other currencies would be pegged to the dollar at fixed exchange rates, adjustable only in cases of fundamental disequilibrium. The International Monetary Fund would provide short-term loans to countries facing balance of payments problems. The World Bank would provide long-term financing for post-war reconstruction and development.
The Bretton Woods system worked remarkably well for nearly 3 decades. It provided the monetary stability that allowed European and Japanese reconstruction and the long post-war economic boom. It maintained relatively free trade and cross-border capital flows, and it anchored expectations in a way that made long-term investment planning possible. But it worked only as long as confidence in the dollar's convertibility to gold was maintained. Confidence that began to erode in the 1960s as the United States ran increasing budget deficits to finance both the Vietnam War and the Great Society programs, and as the global supply of dollars grew faster than the gold reserves available to back them. The credit card arrived almost by accident, born from a man's embarrassment at a restaurant. The story most often told about the invention of the credit card involves Frank McNamara, a businessman who allegedly found himself at a New York restaurant in 1949 without enough cash to pay the bill. Whether or not this specific incident happened exactly as described, McNamara did co-found Diners Club in 1950, issuing small cardboard cards that could be used to pay at a select group of restaurants and charged to a monthly bill. The concept was simple. The card separated the moment of purchase from the moment of payment, and a financial intermediary handled the settlement between the diner and the restaurant.
Bank of America launched the Bank AmeriCard in 1958, a general-purpose card that could be used at a much wider range of merchants, and mailed unsolicited cards to 60,000 households in Fresno, California. The rollout was chaotic. Delinquencies were high. Fraud was significant. The bank lost money in the early years. But the underlying product, a revolving credit line attached to a card that could be used anywhere the card was accepted, proved enormously popular once the operational problems were sorted out. Bank AmeriCard became Visa. A competing consortium became MasterCard. Together, they created the payment infrastructure that would underpin the consumer economy of the late 20th century. Nixon closed the gold window in 1971 and cut money's last physical connection to the earth that produced it. By the late 1960s, the Bretton Woods system was under severe strain. The United States was running large balance of payments deficits, exporting dollars faster than gold reserves could support. Foreign central banks, accumulating dollars through trade surpluses, began to exercise their right to convert those dollars to gold at the official rate. The outflow of gold from Fort Knox became a source of growing concern in Washington. Economists debated the right response. The options were limited: deflate the American economy to reduce deficits, raise the gold price, impose capital controls, or abandon convertibility entirely. On the evening of August 15, 1971, President Richard Nixon appeared on television and announced, among other things, that the United States was immediately suspending the convertibility of dollars to gold. The announcement was made without advance notice to other countries, without consultation with the International Monetary Fund, and without a clear plan for what the international monetary system would look like afterward. It was, in the language of financial diplomacy, a unilateral shock. Nixon called it the new economic policy. Europeans called it worse things. What followed was a period of monetary experimentation, as the world tried to find a new anchor for the international financial system. Exchange rates floated. Currencies were revalued. The dollar fell in value. By 1973, the major currencies were floating against each other, their values determined by the supply and demand of foreign exchange markets, rather than by any fixed arrangement. This was not what the architects of Bretton Woods had intended, but it was, in a pragmatic sense, more flexible, and flexibility turned out to matter more than anyone had fully anticipated in a world of oil price shocks and divergent national inflation rates. Deregulation in the 1980s returned freedoms to banks that Glass-Steagall had taken away, and some banks forgot why. The regulatory framework built in the 1930s held for roughly 4 decades, and the American banking system during this period was, by historical standards, remarkably stable. Banks were protected from competition by interest rate ceilings and geographic restrictions. They were prevented from taking excessive risks by the separation between commercial and investment banking. They were supervised carefully by multiple regulatory agencies. The system was, in the judgment of its critics, inefficient and uncompetitive. In the judgment of its defenders, it was exactly as boring as it needed to be. The deregulatory movement of the 1980s changed the calculation. Inflation in the 1970s had made the interest rate ceilings that protected banks from competition also disastrous for depositors, whose money was losing purchasing power faster than the regulated rates could compensate. Congress lifted some controls, then more. Competition increased. Margins compressed. Banks began searching for higher-yielding activities to replace the profits that regulation had once guaranteed. The process was gradual and then sudden, each relaxation of the rules creating pressure for the next, until by the late 1990s the wall between commercial and investment banking that Glass-Steagall had erected was effectively dismantled, finally and formally abolished by the Gramm-Leach-Bliley Act of 1999. The savings and loan crisis destroyed hundreds of American thrifts and cost taxpayers nearly $200 billion. The savings and loan crisis of the 1980s and early 1990s was one of the most expensive financial disasters in American history, and it happened in slow motion, visible to regulators who often chose not to look. Savings and loan associations, known as thrifts, had been created to serve a simple and socially useful purpose. They accepted deposits from local savers and made long-term mortgage loans to local homebuyers. They were the institutional embodiment of the post-war American dream.
Deregulation in the early 1980s allowed thrifts to expand into riskier lending and investment activities, without removing the deposit insurance that had been designed to protect their conservative original business model. Some thrift managers expanded responsibly. Others did not. A significant number made reckless or fraudulent loans, knowing that if the loans went bad, the losses would be borne by the deposit insurance fund and ultimately by taxpayers. This was moral hazard operating exactly as theorists had always feared it would. By the time the cleanup was complete, more than 1,000 thrifts had failed. The cost to taxpayers was estimated at approximately $130 billion in direct outlays, plus perhaps another $30 billion in foregone interest. A bill paid quietly over years through higher taxes and reduced government services. Derivatives were created to manage risk and gradually became the largest source of risk in the system. A derivative is a financial contract whose value depends on the value of something else, an underlying asset, an interest rate, a currency exchange rate, or even the probability of a credit default. In their original and still legitimate form, derivatives allow businesses to manage risk. A wheat farmer who wants to lock in a price for the harvest can sell futures contracts. An airline that needs to budget for fuel costs can hedge its exposure to oil prices. A bank that has lent money at floating interest rates can swap those floating payments for fixed ones, reducing uncertainty. These are legitimate risk management tools, and they make the economy more efficient.
The problem was that derivatives also made it possible to take on risk without owning the underlying asset. A trader who believed that interest rates would rise could profit from that belief by buying interest rate derivatives, without lending money to anyone or borrowing from anyone. A hedge fund that wanted to bet on the bankruptcy of a corporation could buy credit default swaps, a form of insurance on the corporation's debt, without owning any of that debt. The derivative market grew over the 1990s and 2000s to a notional size that dwarfed the underlying markets it was supposed to be hedging. When problems emerged in the underlying markets, the derivatives that had supposedly distributed risk turned out to have concentrated it in ways that no one had mapped, and some of those concentrations were inside the largest financial institutions in the world. The 2008 financial crisis began in the American housing market and ended inside the balance sheets of banks around the world. The story of the 2008 financial crisis begins with mortgages, and specifically with the practice of extending mortgages to borrowers who had little ability to repay them. These subprime mortgages were made not to be held by the originating lender but to be sold, packaged into securities, rated by credit agencies that had financial incentives to rate them highly, and sold to investors around the world who were searching for yield in an era of low interest rates. The system worked as long as house prices kept rising, because rising prices meant that even borrowers who couldn't make payments could refinance or sell. When house prices began to fall in 2006 and 2007, the losses flowed back through the system in ways that surprised almost everyone. The mortgage-backed securities that had been sold to investors around the world began to lose value. Banks that had held these securities, or that had written insurance on them through credit default swaps, began to face losses. The losses created doubt about which banks were solvent, and that doubt made banks unwilling to lend to each other. The interbank lending market, the plumbing that keeps the financial system liquid, began to seize. And as credit seized, the real economy began to feel the effects. Lehman Brothers fell on a Sunday, and by Monday morning the word contagion had a new and personal meaning. On September 14, 2008, Lehman Brothers, a 158-year-old investment bank that had survived the Civil War, the Panic of 1907, and the Great Depression, announced that it would file for bankruptcy. The decision not to rescue Lehman, made by the Treasury and the Federal Reserve after a weekend of frantic negotiations, was the most consequential single financial decision since Roosevelt's bank holiday. Whether it was the right decision has been debated ever since. The argument for letting Lehman fail was that rescuing it would create moral hazard, the expectation that large banks could always be saved. The argument against was that the financial system was too interconnected and too fragile to absorb such a shock. Governments around the world spent trillions to save the banks, and then debated whether the banks deserved saving. The government response to the 2008 crisis in the United States, the Troubled Asset Relief Program, the emergency rescues of AIG and the major banks, the Federal Reserve's extraordinary expansion of its balance sheet, was effective in the narrow sense of preventing a complete financial collapse. It was also deeply unpopular, in a way that surprised many of those who designed the response. The banks were saved. The bankers kept their bonuses in many cases, and millions of ordinary Americans lost their homes, their jobs, and their retirement savings, with far less government assistance than the institutions that had, in many people's understanding, caused the crisis. The political anger that followed was real and lasting. It fueled the Tea Party movement on the right, which channeled fury at government bailouts into opposition to government spending more broadly. It fueled the Occupy Wall Street movement on the left, which focused on income inequality and the political power of finance. It contributed to a broader loss of trust in financial institutions, in regulatory agencies, and in the political establishment that had allowed the crisis to develop and then presided over a recovery that was robust in the financial sector and sluggish for ordinary households. The crisis of 2008 was, in the end, not only a financial crisis. It was a crisis of legitimacy, a moment when the social contract between the financial system and the society it served was strained to its limit. Mobile banking placed the equivalent of a full-service branch in every pocket, and branch closures followed.
The smartphone transformed banking more quickly and more thoroughly than most bankers anticipated. The iPhone was introduced in 2007, and within a few years, banks had developed applications that allowed customers to deposit checks by photographing them, transfer money between accounts, pay bills, and eventually apply for loans, all without visiting a branch. The convenience was immediate and obvious. The implications for the branch network took longer to work through. Banks began closing branches, first the least profitable ones, in neighborhoods where foot traffic had never justified the cost, then progressively more as the evidence accumulated that customers were comfortable conducting their financial lives through a screen. For many customers, especially younger ones, this was fine or better than fine, faster, more convenient, accessible at any hour. For others, the elderly, the less digitally literate, those who lived in places with unreliable internet access, the branch closures were a loss of something that had been more than a financial service. The bank branch had been a physical presence in the community, a place where relationships were built over time. When it closed, something was lost that an app could not fully replace. Cryptocurrency proposed a world of money without banks, and the debate about whether that is possible continues. In 2008, the same year that Lehman Brothers failed, an anonymous individual or group using the name Satoshi Nakamoto published a paper describing a new kind of digital currency called Bitcoin. The paper proposed a system for making financial transactions without any central intermediary. No bank, no clearinghouse, no government agency. Transactions would be recorded on a distributed public ledger called a blockchain, maintained by a network of computers around the world, none of which had special authority over the others. Trust would come not from institutions but from mathematics.
Bitcoin was initially a curiosity, valued by cryptographers and libertarians who were attracted by its resistance to government control. It grew slowly, then suddenly, then explosively, reaching values that made early adopters wealthy and drawing in a wave of speculative investment that bore more than a passing resemblance to the bubbles of previous centuries. The cryptocurrency market expanded to include thousands of alternative coins and tokens. Businesses were built around trading, lending, and investing in digital assets. Regulators struggled to keep up with the technology and a market that had been designed to resist regulation. What cryptocurrency revealed, whatever its ultimate fate, was a genuine popular hunger for alternatives to the existing financial system, a hunger rooted in distrust of the institutions that had been bailed out in 2008, in frustration with fees and friction and exclusion from services that the existing system had never adequately extended to everyone, and in a more diffuse but powerful sense that the arrangement between ordinary people and the financial system had become too favorable to one side. Whether cryptocurrency can deliver on its promises is a question that has not been answered. Whether the hunger it expressed is real is not a question at all. The story of banking is the story of trust, extended, broken, rebuilt, and extended again at ever greater scale. Every institution we have visited on this journey, from the Mesopotamian temple with its clay tablets to the smartphone bank with its algorithmic credit decisions, was, at its core, an arrangement of trust. A depositor trusts a bank with their money. A borrower trusts a bank to extend credit fairly. A bank trusts its counterparts to honor their obligations. A government trusts its banks to maintain stability. And the financial system as a whole operates on a foundation of trust so pervasive and so structural that it becomes visible only when it fails. Trust in banking has failed many times. It failed when the Bardi and Peruzzi overextended themselves to a king who saw no reason to repay. It failed when John Law's paper empire collapsed and thousands of French families found their savings worthless. It failed in October 1929, when stock prices fell and bank runs began and 9,000 American institutions closed their doors. It failed again in September 2008, When the interbank lending market froze and institutions that had operated for centuries suddenly could not be certain that the counterparty on the other side of a trade would still exist in the morning. And yet, after every failure, banking has been rebuilt. Sometimes better, sometimes worse, sometimes with the same mistakes codified into the new structure, waiting to create the next crisis. But always rebuilt because the alternative, a world without the ability to extend credit, to store value, to transfer money across distance and time, is a world that no modern economy can function in. The need for banking is as real as the need for roads or communication. What changes slowly and painfully is how we build the institutions that meet that need. If you are still awake and you would like another slow journey through the past, there will be a next video waiting for you on the screen. You can simply let it play and keep following the thread of discovery wherever it leads. And if this episode brought you calm curiosity, you might like, subscribe, or leave a comment. It helps the channel reach more listeners who need a softer place to land. But for now, you do not need to navigate anything at all. Let your jaw unclench. Let your shoulders drop. Feel your breathing find an easier rhythm. In and out like a tide that knows exactly where it belongs. Imagine the last light fading behind a quiet horizon and a steady world moving forward without effort. Sleep well and good night.